We don't set ourselves up for failure in the ready to retire process. We know that time heals most every wound that you can get in the market.
Our final question this week comes from Haley in Little Rock. I read recently that consumer spending is strong and the economy should respond accordingly. But I'm still a little on edge. What goes up must come down, right? What type of investments should I focus on to maintain growth, but also reduce risk in a potential economic downturn? Haley, thanks very much. And you're right, the economy is currently on solid footing. Growth may be slowing, the rate of growth, but the economic data does still show that the economy is on solid footing. But the thing that you should know, too, is not being too microscopic about this. The economy is always cyclical. That's the part that you need to understand on the what goes up must come down. A recession is always coming at some point. We're going to have a recession. But here's the reality that we have to point to. From 2021 through about 2023, an overwhelming majority of the nation's leading economists were predicting an imminent recession in the United States.
Anytime. It was going to happen.
Yes.
It was just a lock. So many people, made the wrong decision at the wrong time for the wrong reason because these economists were running their mouth about what they thought was going to happen.
Yeah, and you think about that, John. So many people, what did we do? We had a lot of CD requests, right? And for short-term money, that worked very well for our clients and should have happened, right? But when you look at that 5%, that feels pretty good. I'm going to sit there and put no risk to principal and get my 5%. But look what the market did over the last couple of years. You would have missed out on that growth for sure if you made a decision based on what you thought was going to happen in the economy. So don't do that. What matters more than the economy is your economy. You talk about what goes up must come down. You think about our prior question. The longer you stay in, yes, it's going to be up and down along the way, but it's like an escalator. You're going to start at the bottom floor, and you're going to feel like maybe if you run up and down that escalator, that's going up and down, but it's steadily on that glide path, and you get to the second floor. And that's kind of the way the market is if you can ride out those storms. So generally, when she says, what type of investment should I focus on to maintain growth but also reduce risk in a potential economic downturn? The answer for Haley, John, is to plan for there to always be an economic downturn.
That's right. And that's why the ready to retire process is set up like it is at GenWealth, because we don't set ourselves up for failure in the ready to retire process. We know that time heals most every wound that you can get in the market. If you go back to our last question, the 10-year time period of the S&P 500 since 1937, any 10-year time period, the average probability of a positive rate of return is 97.3%. So we just simply stack the odds in our favor and say, okay, for the money that you're going to need 10 years plus in the future, we're going to invest that in equities because we know the chances are fairly high that you're going to get a positive rate of return. But if you are going to need money very soon, then we're going to invest that in something very, very conservative so we know that we can deliver that money to you when you need it. That's from an income standpoint. But Scott, let's also talk a little bit about how you might think about hedging an equity portfolio if you are just going, okay, I want to be sure that I don't give up what I've got or anything of that nature. So there are a lot of things, a lot of ways to hedge an equity portfolio. You can do it on a portfolio level basis where you go in and actually buy some hedging opportunities, some strategies that would pay if the market went down. Options on that portfolio can do that for you. But the thing that I want to be sure that everyone understands, anytime that you are efforting to take away risk, you're going to give up something. There's going to be some type of either explicit or implicit cost to that hedging that you're trying to do.
Yeah, I think Haley's age matters here, time horizon to retirement matters here, but there are annuities offered out there as well that will help you reduce risk and maintain some level of growth, and that depends on the provider, that depends on the product, and I would certainly say annuities are complex products and should never be entered into without the help of a financial advisor to determine what might be right for you. So that little disclaimer first, but there are annuities out there, John, that offer an index credit. Right, you're putting your money in, and you are going to have to lock it up for a certain time frame. So there is something called a surrender period there. So you can't expect to touch that money for some certain level of time. But during that time period, you may be able to get a portion of the index performance if it's positive, while at the same time buffering. On the downside, the insurance company will protect a certain percentage of the money you put in and protect against losses.
Yeah, and essentially what you're doing there is you're taking what could be done on a portfolio level with options and actually doing it in a group type setting with an annuity contract where the insurance company is using their expertise to play those options and to absorb the risk if it's on the wrong side of the equation.
Yeah, but the planning process, Haley, is what you need to work through first. We talk about it all the time. We're planners first. We want to build the plan. We need to know where we're going before we develop an investment strategy on how to get there, because everyone's situation is truly unique, and we would never make specific investment recommendations on this show without understanding that from you first.